Okay, so today we are going to be talking about a topic that I always try and explain to new buyers, and I know it's something that isn't easily explained, so I thought a video would be a good way to do this. So we are going to talk about contingencies today, what those are and what that means throughout the home buying process. So I would like to share my screen with you. And okay, so these videos can all be found on my YouTube channel, Let's Talk Real Estate with the Mom Boss Realtor. Please go and subscribe. There's tons of good knowledge bombs being dropped there. So that's my selfish plug, like, subscribe, share. Okay, so what the heck are contingencies? Okay, so the word contingency is thrown around a lot in the real estate world when you enter a transaction. You'll hear contingency removal, you'll hear contingency periods, and oftentimes as a buyer, they're like, well, I don't understand what that means. So, they keep using this word. Kind of like the video I did the other day where we talked about comparables. Everyone always talks about comps and no one ever knows what it means. So this video is to explain what real estate contingencies are. So what I want you to do is I want you to think of your contingency as a safety net. So by definition, a contingency is a provision in real estate in the contract that makes the contract null and void if a certain event were to occur. Think of it as an escape clause that can be used under defined circumstances. It's also sometimes known as a condition. So typically conditions are in funding and contingencies are in the real estate contract. So basically they're your outs, right? Well, what does that mean to us? How does that work? Well, let me explain. So when I open escrow with a client, I mail out a package. They actually get a welcome to escrow package, which is kind of cool. It's got, some little things and something to post on their fridge, on their timelines, because timelines are important. But it also has a breakdown of what contingencies are. I've gotten a lot of feedback on it as it being very helpful, so I wanted to take you through it virtually. So when you write a real estate contract, you'll put up a deposit. It's called an earnest money deposit. It's similar to like if you were to book a wedding at a venue and they want you to do a deposit. It's kind of like a good faith deposit, right? So in real estate, you have the same thing. It's typically 1% of the purchase price. It doesn't always have to be, especially when you're using programs that are zero money down. Sometimes it's been a very minimal amount, like $1,000, and sometimes it's much more than 1%, depending on the purchase, depending on how aggressive you need to be with your offer. So this earnest money is what is held by escrow. So escrow is basically the middleman between the buyer's agent and the buyer and the seller's agent and the seller. This earnest money deposit is kind of on the line should we remove our contingencies, remove everything, and then decide to cancel for whatever reason. Sounds kind of risky, but we're fully protected, and here's why. So we have typically, this is in a typical contract. Oops, let me go back. Oh no. Okay, so in a typical contract, we typically have 10 days to do our physical inspection contingencies. So that means that we'll have a period of 10 days to get as much of our due diligence done on the physical aspects of the property as possible. And I'll go into what that means on the next slide. Then we have 17 days for our appraisal contingency, and then we have 21 days for our loan. Again, I will break all of these down as we go forward, but think of contingency timelines as safety nets guarding your earnest money deposit from loss. Contingencies are the seller's requirements that are negotiated for you, the contingency timelines. And they're removed on certain days depending on the transaction. The standard is 10, 17, and 21 in this market. So what does that mean? What contingencies do we have? So that means that we have several different ones, and typically they start with the title report. So we cannot sell a home if it has a cloud on title. Well, what does a cloud on title mean? That means that maybe there's a lien on the property. Some can be as significant as an IRS lien. Some could be a mechanic's lien. Maybe they didn't pay a contractor at some point. So we're checking the title report to make sure that there are no liens on the property or what they call clouds on title. We're also making sure that we understand the boundary lines, easements, anything along those criteria. Then we also do home inspections, and we're going to do a video on the importance of a home inspection, but typically there's a general home inspection, and that general home inspection uncovers any other items that we may want to look at. So for instance, if a general home inspector says, hey, this HVAC system, heating and cooling system, needs some repair, some part of it's not working, then we may want to have an inspection done by a specific HVAC contractor. If there's a plumbing portion, then we may want to have something done with a plumbing professional. If there is something, you may want to do a pipe inspection. I highly recommend that you do a pipe inspection on all of your properties if it's not in an HOA, because you as a homeowner are responsible for that piping from your house to the street, which a lot of people don't know. So those are different things. Also disclosures. Disclosures are a big deal, and that's the seller announcing to the buyer everything that they know about the property. There's a funny question that says, well, how long, if someone died on the property, how long until you don't have to disclose it? Well, the thing is if you know about it, you have to disclose it. It's unethical for you to withhold information regardless of how long it's been. Then we have the appraisal, which says that we're not paying more than what the property is worth. We have HOA documents if they apply. If you have a 300-pound elephant as your pet and all of a sudden the HOA says you can't have elephants, that might be something that you reconsider this property. The loan, our ability to retain financing is a condition or a contingency as well. And if you have a home to sell before you buy, that would also be in there. So these are our contingencies that are in place throughout the transaction. And during these specific milestones within the transaction, we will remove them as our due diligence gets completed. I hope that this makes sense thus far. So during our due diligence period, we're getting all of the reports. Do we need extra inspections? Do we need to have other people go out there and look at it? If the general home inspection says that the floors are uneven, does that mean that there's something with the foundation? Do we need to have a foundation inspector come out there? Do we need to have an architect of some sort? Do we need to have the city come out and check permits? Do we need to look at permits? All of those types of things will be done in that time. We will negotiate and request for repairs. So technically, per paragraph 11 of the RPA, which is the residential purchase agreement, which is the contract you use with the seller, it says that the home is being sold as is. So off the bat, typically that's the idea, is that there's no repairs that are going to be done to the property. Does that mean that we cannot request them? No, absolutely not. We can request any and all repairs that the buyer would like to have done, and we can do it in a couple different ways. We can ask that they have them physically repaired by a licensed professional if you don't want to deal with the repairs yourself. You can ask for a credit for what you think those repairs would cost that will come to you through escrow at closing, and they'll come as non-recurring and recurring closing costs, which is just a lot of verbiage that the lenders use for that. Or you could do it as a reduction in purchase price. Those are your three options. Now the seller can oblige, they can compromise, or they can completely negate your request. It is completely up to them. Then we will decide if this is still the home for us. If we submit a repair request for $10,000 worth of foundation repair and they say, heck no, they're not going to do it, then we may decide that this is not the right property for us. And if that's the case, during this due diligence period, we can cancel the contract and at no liability to us. And so that is really the purpose of this, is to be able to do our due diligence, do our homework on the property, and make sure that it's still the right house. Let's talk about appraisal issues. So a third-party appraiser will be assigned by the lender to go out to the property. Actually, it's not assigned by the lender. It's assigned by an appraisal management company. So they are an unbiased party. And the appraiser goes out and they look at the property, look at what we're buying it for, and make sure that that is what they consider market value. They'll look at other comparables, like my video talked about previously, and they'll see how this property compares to those and if what we're paying is the correct price. So if our appraisal comes in at value, we're good to go. We move on. There's no question here. If the appraisal comes in above value, that's awesome. We move into the house with built-in equity. The seller cannot ask us for more funds, and we are in a really good position on this purchase. You know, if it comes in under value, for example, we're willing to pay $600,000 because we were in a bidding war, and the appraisal comes in at $585,000, let's say. So we're $15,000 away. There's a couple of things that can happen. Number one, the seller can ask us to come in cash the difference. They can ask us for $15,000 to come in at the purchase price that we were asking, or that we agreed to purchase with. Now, most people don't have that extra cash on hand. So if we did not agree and the seller would not waive on that topic, then we could cancel the agreement. They may drop the price to the 585, which would be good for us, or we can split the difference. So that's how the appraisal works. The loan, well, what happens if I lose my job and I can't get the loan anymore? We leave the loan contingency in place up until the 21st day, and most escrows are going to be right around 25 or 30 in this market. So we're pretty close to the end when we make sure that the lender has the clear to close and we are good to get in line for docs. So we're protected almost all the way through. Doesn't mean that stuff still doesn't happen, like we're seeing in this time with the coronavirus and people losing their jobs. And that's where that earnest money would come into play. And hopefully you have a good agent to negotiate with you if something like that did happen. But for the most part, if you're on top of your contingencies, if you're doing your due diligence, if you're on top of your timelines, and if your agent is being your advocate, you shouldn't have an issue or any type of fear about this at all. So what happens after I do all my due diligence? So once everything is done, you've looked at all of the reports, the appraisal's back, the loans are good to go, we are in a position to make sure that the property still meets our needs and we're happy with the negotiations and the results. Then we close escrow and become homeowners. So that's really what that is when we talk about contingencies. I hope this was informational. I hope that this was helpful. I hope it broke it down, didn't make it too confusing. I hope it gave some good visuals so you can kind of understand it a little bit better. If you have questions, please drop them in the comments. Like, share. Thank you so much, guys. Have a great day.